तो बता दिया।
वो तू नक्की कर यार, ठीक है नहीं है, ठीक है। स्लाइड चेंज करना। अच्छा यू स्टार्ट विद स्लाइड।
आप टैप कर दो, आई चेंज।
Do I have to introduce Dhan Ki Baat or something? And investor, no, no, I can straight away. Start. Good evening, friends. So the topic for today is essentially how asset allocation helps investors, and ultimately asset allocation on one hand, and how to allocate those assets within equity and debt, and then how to best utilize SIP and SIP top up as a means to achieving the goals. So I will be probably covering all of these three in the next 20-25 minutes, and then open up for questions which are there on webinar, and as and when the questions are received, I will answer them in the end. And thank you for participating, or thank you for listening. Hopefully it helps you in terms of understanding what we mean when we say asset allocation, and the two concepts of SIP, SIP top up, SWP and STP. Essentially when we invest or when we earn, there is one component of savings, and it is very important to invest those savings in the right manner. What are the objectives when we invest? The objectives are very simple. We want to beat inflation, because if we don't beat inflation, the money essentially does not grow at all. There are different goals which all of us have, depending on which age cycle we are in. As a teenager, we are looking forward towards education. Then there could be a requirement for home. There could be a requirement for vacation abroad, and so on and so forth. And to that extent, it helps us if we are able to invest in an asset class, if we are able to invest in a way where the investment not only beats inflation, but if we let it grow, or we keep that investment for long term, the benefit of compounding, which is essentially the green dots if you look below, the benefit of compounding is something which helps investors grow their money much faster. So if you start with investing, say 1 dot, if you see on the green dots which are there below, if you start investing with 1, which is essentially saying you can invest in bits and pieces, and then it keeps growing to 2 to 4. By the time the fifth cycle of doubling your money comes in, you've grown from 1 to probably 16, and effectively that's the power of compounding. If you leave your investment and let your investment grow, the power of compounding is something which is called as the eighth wonder of the world, and that is essentially something which equities kind of bring on the table in terms of the benefit of power of compounding and the ability to beat inflation. So essentially, if you look at when I say asset allocation, what does it mean? Typically, whatever we save, there are a few asset classes in which we can invest. One is equity, fixed income, just real estate, precious metals. Typically, these are the almost 99% of the wealth is in these. Then that could be art, etc. for those who are very savvy. But essentially, most of us invest in these four asset classes. It is very important to note that we should have a very good mix of these asset classes. No single asset class should actually overpower or overweight in terms of the asset allocation which we have. And to that extent, an advisor or a financial advisor can actually help in planning not just our current portfolios, but in seeing how in the next 20-30 years the portfolio should look and how the portfolio should move between these asset classes. One thing that's most important is that if an asset class has given very good returns in the past, typically it is an asset class which becomes expensive. It is important to probably not invest a very large sum of money at that point of time in that asset class. Keeping a balance of asset class in terms of asset allocation is very important, and that is determined by the risk appetite of each investor. The risk appetite is not something which is determined by how much money you have in your bank balance. It's a lot to do with your own attitude. It's a lot to do with your own personality. So each person has a different risk aptitude, and if you know that your risk profile is aggressive, moderate, or conservative, basis that your asset allocation can be devised by your by your advisor, and then you can continue allocating in that proportion. The most important is that to keep your asset allocation intact and to probably once in a year. You don't need to see it every year, but once in a year, if you see your asset allocation in terms of the different equity, real estate, precious metals, and fixed income, if you have, it helps you in terms of your long-term goals as well. So one way of achieving, or one way of one of the modes which are there is available is mutual funds. What is a mutual fund? Is essentially where many of the unit holders invest, and a professional fund management team, which is the asset management company, manages the funds on behalf of the unit holders. The various benefits are enlisted in front of you. It is very convenient. You can do it on your mobile phone these days. You can do the investments on your mobile phones at a time, as far as whenever you get time is concerned. In terms of transparency, if you see every month there is a fact sheet which comes out, so you know exactly where your money has gone, where the scheme is investing where, and there are enough different independent agencies which bring out their reports on various funds as well, which can also help you get some idea as to where these funds are investing, what are these funds doing. And of course, the biggest benefit, the way I see it, is that you can invest very small sums of money, which I will probably explain in STP, very small sums of money on a daily, weekly, monthly basis. And even if it is, say, as low as 500 rupees, you can start investing in mutual funds and allow your investments to grow. So even the smallest investor can take the benefit of professional expertise of fund managers, and that will help in terms of the long-term growth of our own corpus, no matter how big that corpus is. And if we see in terms of the regulatory provisions, in general, India's financial markets are one of the most well-regulated. We have seen 2008 financial crisis. We have seen European banks going through crisis, but Indian financial system has been kind of very well protected because of the strong regulations which the Securities Exchange Board of India and RBI have in terms of the control on the financial markets. So the question keeps coming is why invest in equity mutual funds now? Is this the right time? The fact is that if your asset allocation in equities is zero, and just to highlight, India's asset allocation in equities as a proportion of overall wealth is about 2.5 to 3%, which is very, very low compared to the developed countries. So there is scope to increase equity investment. If we all look at our own portfolios, probably our portfolios are heavy towards real estate and very, very limited in terms of equities. So is this a right time? Is this a wrong time? I think from an asset allocation point of view, it never hurts to start investing in equities. And the best way probably to invest in equities is to SIP and keep those SIP for long term, keep the investments for long term. And if we see in terms of valuations, the markets are not as expensive or very expensive. They are nowhere close to what 2007 valuations market had reached. In fact, in terms of the economy itself, if we see, we are not in a late cycle or an expensive cycle. We are somewhere in the mid cycle. We are about to see GDP growth pick up, and that should help earnings growth, given that the capacity utilization, or in other words, the companies which have capacities created or their factories today are producing at less than capacity, can see the benefit of demand improvement, seeing the capacity improvement in the system. So essentially, right now the systemic capacity utilization is 70. When that goes up, profitability can improve, and that should help in terms of the markets going up. Most important is that you should have a long-term view when you're investing in equities. Equities is not an asset class where you invest for 1 year or 6 months, and definitely it helps if you are going to do it systematically via SIPs or STP, which I will explain later. So one key question which keeps coming is, are there risks to equity? Of course, equity, or in general, there are going to be risks which are internal, which is domestic, as well as external. So currently, if you see the path which has shown, how will be the corporate earnings in the backdrop of GST? It is something yet to be seen. In the long run, we are in the long run we can be sure that the organized sector will benefit out of GST, but in the short run there could be some amount of imbalance, or there could be some amount of confusion in terms of how the corporate earnings actually will come up, and that can lead to some amount of lack of confidence in the market. If we see oil price fluctuation, geopolitical risk, a bad monsoon, which doesn't look like right now, monsoons seem pretty good all over India. And if we see the trade policies or the protectionist policies abroad, which hurt India's ability to import and export, that can also have an effect. But all of these seem like right now India is in a good position. If we see India in terms of the global scenario, it is the largest, fastest growing economy in the world. And if we see our macro parameters are all in control in terms of GDP, fiscal deficit, and current account deficit. So from an economy, micro or macroeconomy point of view, we are on a strong footing. And to that extent, if we see FIIs, FPIs, FDIs are looking at India as a good, attractive destination where interest rates are still high. So effectively, when I said asset allocation, what does asset allocation mean? Typically what happens is, if we are invested, well invested across the 3 or 4 asset classes which I mentioned, you will find that one of the asset classes which does very well becomes a very large proportion of your overall portfolio. When you rebalance it every year, what you do is essentially you sell high, and then in other words, the asset class which has become much larger proportion of your overall portfolio, you will sell it when it is at a high level, and in turn you will buy an asset class which has probably not participated, so you'll buy low. Typically that's what an asset allocation strategy or the dynamic asset allocation category does. It buys low, sells high, it rebalances portfolio, and from an investor point of view, it is giving valuation based, it helps investors in terms of participating in the cheaper asset class, at the same time booking profits at regular intervals. So dynamic asset allocation category takes care of the investor's need to rebalance the portfolio, and since it is being done at a professional level, the investor's involvement on a day-to-day basis is not required, and the rebalancing essentially leads to wealth creation in the long run. So if we look at next, if we look at what is the aim of dynamic asset allocation funds, so if you keep regularly investing in dynamic asset allocation funds or in equity, small sums of money ultimately, because of the power of compounding, become large. So when you invest in equities, do not have a 1-year view, at least a 3-year view, but ideally I would say that if you actually start investing early in your career, and you can also tell your children that the moment you start working or the moment you go out of college, if you can start investing, even if it is 500 or 1000 rupees, if you allow it for 20-30 years, the sum of money accumulated can be significant, and that will take care of all the requirements which come in terms of the various goals which one can have. Some of the goals are explained in front with an example. If someone had started a 5000 rupee SIP, what is an SIP? Every month 5000 rupees gets invested in a fund, and if that SIP had continued for 14 years, which is till 2014, there are the different goals which the SIP itself would have taken care of. So while we believe that 5000 is a small number, or 5000 is a small amount to save monthly and we all can do it, very rarely most of us have the discipline to actually do it. And just to show that if that 5000 rupees it grows by almost 95 or 1% a month, if it grows, you can at different intervals satisfy the different goals and consume the different requirements which you have. For example, you can buy a car. So in the example which is given, somewhere in November 2005, if you wanted to buy a car, the investments which you have done in the last five years are taking care of your requirement. You don't need to take a car loan. You don't need to take the other savings out. You don't need to bother about taking any other investments or liquidating any other investments. You can actually take that money which has grown from the SIP at an assumed return of 12% an annum. You can actually buy the car in November 2005. You could go on a vacation and spend another 5 lakh in 2011, and then you can buy an expensive gadget in 2014. So this is just an example to say that at different intervals you'll need lump sum money for different purposes and achieving different goals. It could be marriage as well. It could be children's education. It could be a health emergency. All of it can be taken care of by ensuring discipline in saving. So the most important takeaway is disciplined saving via systematic investment plan. Continue with the systematic investment plan. What happens is when the market goes up, everyone invests or starts the SIP, and when the markets come down, you end up stopping the SIP. That does not work. SIP is meant to be for long term. Continue with the SIP across market cycles, because equity markets have cycles. They go up, come down, they go up, they come down. But as the economy grows, as the nation grows over long periods of time, ultimately the trajectory of the equity markets has been higher, and it is a reflection of the economy. So if we believe that 10 years down the line India's economy is going to be larger, then our equity markets is also probably going to be larger, and the index barometers will also be probably higher than where we are today. So SIP is a very simple concept, and it has probably been understood by all you investors. Something which probably is not well understood, or something which needs more focus from an investor point of view, is the concept of SIP top-up. What is a SIP top-up? Essentially, if you see, every year we get our increments, every year our earnings grow in line with whatever is the growth in the economy or in terms of the salary levels. But if I start a SIP and do not have a SIP top-up, what is a SIP top-up essentially? I start a SIP on year 1 by 5,000 rupees. If I have a SIP top-up which I enabled by saying that, okay, next year and the year after that and for the next 10 years, for example, 10% increment or 500 rupees should be added to my savings and investment, or 500 rupees should be added to the SIP value. So first year I start with 5,000. Next year my SIP amount will be 5,500. Third year my SIP will be probably 6,000, and so on and so forth. So essentially, as my income grows, my savings will grow, and as my savings grow, my investment will also grow automatically without me having to intervene. It also takes care of your asset allocation in the right mix, because there maybe if you actually see and go back at your own finances, last 10 years your salary or your business income may have increased significantly, but your SIP amounts or your investments in mutual fund may not have caught up pace with the increase in savings, not because you didn't want to do it. It's just that because you had not enabled SIP top-up, or the SIP top-up feature was not there, and your focus was not there on your investment part, and you weren't making your money work as hard as you work for earning the money, the SIP amounts remain the same, static. You may start 1 or 2 other SIPs, but it is not in line with the growth in earnings. So to that extent, SIP top-up actually helps an investor achieve the goals quickly, and this is just one more example. So if you enable the SIP top-up, again all the data there, you can actually end up doing a lot more with the same SIP and SIP top-up investments which you are doing, and you will be left with some more money. In other words, SIP top-up, if you see the next slide, what does SIP top-up do? So just to explain the slide, if you had invested in SIP, just SIP of 5,000, and you kept it from 2000 for 17 years, your corpus, accumulated corpus at an assumed return of 12% would be 33 lakh rupees. The same thing if we see, if you had SIP top-up, yes, you would have invested more as shown in that orange chart. So instead of 10,45,000 investment which a pure SIP would have done, your investment would have been higher. Your saving would have been higher, your investment would have been higher at 25,59,044 rupees. And that the difference in your savings or the difference in your investment is also reflected in your corpus size at the end of the tenure. So if you had invested only 5,000 rupees static for 17 years and it would have grown at 12% per annum, the corpus which you had with you would be 33 lakh rupees today, which is the red line. And the same thing if we see, if you had SIP top-up, while you would have invested more at 25 lakh rupees, your corpus would be at 62 lakh rupees. So you see the difference. Instead of 33 lakh, you would have had 62 lakh. You would have saved more, you would have invested more, and the benefit of that would be in compounding, which is what this graph is showing. So SIP top up is something which I urge all of you should have. And if you have existing SIPs which do not have the SIP top up feature, it would be worthwhile to take out time over a weekend, call your financial advisor, and add that SIP top up feature on the SIP, so that at least we can't change what has happened in the past, but going forward, with the growth in line with the growth in your earnings, the savings and investment increases without you having to intervene. So with that, I've explained SIP. SIP is very simple. SIP top up is essentially adding to your savings and investment level every year at a particular predefined level which you can decide. You can also decide, okay, probably uh, our goals are near. For example, as a 14, 15-year-old, I know that in 3 years' time I may need to go abroad for studies, and I need to take that corpus, or I need to have that So, just one thing, while I spoke a lot about equity markets and equity funds, equity mutual funds. Uh, Equity mutual funds are still only about one fourth or are one fourth the size of the entire mutual fund industry. Two-thirds or three-fourth of the mutual fund industry is the fixed income side, which not many of you know. So what I would urge, in the interest of time, I'm not going in detail, but what I would urge is that please educate yourself on fixed income funds as well. They are a good asset allocation tool for those who do not want to, or some part of your portfolio which does not need to be in equities or cannot be in equities, is required for any emergency purpose or just a corpus which you want to keep it without linking them to equities, then the fixed income instruments is something, fixed income funds is something which you may want to invest in from a long-term point of view. And there is, at current, there is a indexation benefit you get. So if you keep your money in fixed income debt funds, if you keep them for 3 years, you get an indexation benefit. So you keep the money for more than 3 years, you get taxed at an index cost and at a tax rate of 20%. So this is just an illustration as to how the benefit of indexation helps. So in very simple terms, if I have to see, if you had invested in 2013-14, 1 lakh rupee each, the first column is with indexation, the second column is indexation. And if you see the second row, which is the index cost of investment, it is essentially based on the inflation numbers which are there, or the inflation adjustments which are there, cost inflation index, which is published by the RBI. So that 1 lakh, if you have indexation benefit for 3 years, if you kept, will increase to probably say 1,20,000 if the assumed inflation rate is 9%. If the inflation rate is say 7%, that number would come down to 1,16,000 odd, etc. So essentially, the indexation ensures that your capital gain, or the gain on which you will be supposed to pay tax, comes down, and that too at a rate of 20%, and not the marginal rate if you are in the marginal tax bracket. So there is a significant difference in the taxation which you will end up paying if you've invested in a debt mutual fund and kept it for 3 years, vis-a-vis getting taxed at a marginal rate, because you get the indexation benefit as well as the benefit of getting taxed at 20%. Next. So within debt as well, like I said, what is it that is what we like right now, and from an investor point of view, we would urge them to look at from an incremental investment. One is the entire category of accrual funds, and the other is if someone is interested in investing for the real long term and take advantage of duration, then there's a model based duration funds. So essentially, to sum up, what we have covered today is that the benefit or the advantages of investing in the different asset classes to ensure that your asset allocation and wealth creation happens. Just one snippet, I would say that wealth creation or asset allocation is responsible for creation of 87% of your wealth. Within that asset, what you choose does not matter. So if you don't get your asset allocation right, there is a high probability that you will not create wealth in the long run. So most important is first focus on your asset allocation. Once you know your asset allocation based on your own risk appetite, and it is different for every individual, you can choose the investment or instrument to invest. Mutual funds provide a good transparent platform to invest, and if you see equity, debt, real estate, investments, etc., through the mutual fund route, the transparency levels are high and you get professional management. What are the different ways in which you can invest? I spoke of systematic investment plan. I spoke of systematic investment plan with a top-up feature, which is SIP top-up. I spoke of systematic transfer plan, which is investing in equities through parking in a debt fund route or through investing in a debt fund route on a daily or a weekly basis. And then finally, after you've invested through either of these three routes or the lump sum route, there are goals which you need to save for. There are goals which you need money for. The right way to probably withdraw money to achieve those goals, because you know your goals are predefined other than it being an emergency, you basically have a systematic withdrawal plan in place. In other words, if someone needs money at 18 years of age, then you can think of probably redeeming from 16, or you can think of systematically withdrawing from equities at 16, 17 through the systematic withdrawal plans. I spoke of fixed income instruments where currently the investors are not invested significantly in terms of fixed income mutual funds. And with that, probably I'll open up for Q&A on the web. So while I was talking, we have a few questions. Which have already come, and I'll take them up. So what the first question is about taxation of STP or rather systematic transfer plan. How is it taxed? So there are two components to it. One component is where the money is moving out of. The other component is where the money is moving in. So the money which is going out, you will get taxed at the marginal rate, because typically it will have not completed 3 years and it is a debt product. So that's as far as taxation concerns. It's very simple. It's very similar. If you have a investment in bank account, and from bank your money is going into an equity fund, it's similar to that, just that probably versus a bank savings account, there is a high chance that you may find a fixed income debt fund give you more flexibility in terms of a daily transfer into equities. The second question is essentially on how safe is my investment in debt fixed income mutual funds. So it's a primary responsibility of an asset management company to manage funds in a way that the investor's interest is protected. At the same time, because we are investing in a market which is the same, it's a free market, there are times when one or two investments which we will make will not go as per our plan. So as far as fixed income instruments are concerned also, there are different levels of quality paper within fixed income mutual funds for different funds which are there. So as an investor, you can actually reach out to your advisor and understand as to which fixed income investment or which fixed income fund is of good quality in terms of its own paper, or what is the paper quality of that fixed income fund, and then suiting your risk profile. So what is very high quality will definitely have a yield which is much lower, because quality will be priced that way. And at the same time, if you need a bit higher return, then you may want to go down the quality curve. In other words, say for example, a AAA rated paper will be priced at a particular level, a AA rated paper will be priced at a different level, or the yield or the interest rate on a AA rated paper will be higher than the yield or interest on a AAA rated paper. So from an investor point of view, if we see fixed income funds or fixed income funds are of different types, and if you want to be very cautious, you have those kinds of funds as well. If you want to take a little bit of risk to ensure that your yields are higher, you have those kinds of funds as well. But as asset managers, it is our responsibility to ensure we take the best due diligence in place. And so far, in terms of our own experience for the last many years that we've been managing fixed income and the regulatory and regime which is there in India, we are in quite a strong position to ensure that the investors' interests are taken care of. The third question is about markets in terms of how do we expect the market to grow in the next 3 years. So it's a question which mathematically is easy, but whether that will be achieved or not is depend on many of the macro factors which was mentioned in that start to end grid, wherein a lot of external and internal factors affect the markets. Flows affect the markets, how much money comes into the market, what are the policies of the government, what is happening globally. So with the caveat that we cannot predict next 3 years exactly what's going to happen, but what we know is that India's GDP over the next 3 years will grow at a rate of 8 to 12% on a nominal basis. And when that happens, typically the market also grows. If you see the past history for the last 30 years, as the GDP has grown, so has the overall market cap. And there's a linear line in that sense that GDP has grown, market has grown. Just that the volatility in the market is high because there are many factors which affect the equity markets. But if you remain invested for long, 10 years, 20 years, 30 years, in line with the growth in GDP, the markets have grown, and those who've remained invested have actually benefited significantly through their compounding power. So, where do I expect market 3 years down the line? Clearly, if the way macro situation in India is today, the markets will be high. How much higher is difficult to predict, and global situation can be different. But to get a good risk-adjusted return, we believe that it is possible that in the next 3 years, our economic capacity utilization will move from 70 to say 80 or 85, and the benefit of GST will ultimately kick in. So things look positive over the next 3 years, but it's something which, to put a number to it, is very difficult. And a related question is, at current level of Sensex, should we invest in equities? I could have asked this same question when Sensex was 6,000 in the year 2006. I could have been asked the same question when Sensex was 20,000 in the year 2008. I could have been asked the same question when Sensex came down from 2008 20,000 levels to as low as 8,500 levels in October 2008. The fact of the matter, it is not about the Sensex level. It is about the asset allocation which you have for the wealth that you have or for the corpus which you have. So if your investment level in equity is zero, I would say that you have to start investing. If your investment level in equities is 100%, I would say you may need to look at using the SWP feature to take out money over the next 3 to 4 years and balance your asset allocation so that you reach a level where you are comfortable with. It could be 70 equity, 30 debt. It could be 50 equity, 50 debt. It all depends on your own risk appetite. So, is this the right time? Actually, it depends on what your asset allocation is, and it is different for each investor. So, to that extent, I would say that each investor should know their own asset allocation and accordingly invest when market levels. And currently, of course, SIP top up, and STP are a good way to invest. And if someone wants to invest in a lump sum or a large corpus at one go, then dynamic asset allocation as a category is something which that investor should look at. The next question is on the benefits of STP. So while I was actually talking in the beginning, I had mentioned, but I'll probably go in detail and we'll end the session at that. Be it SIP, be it SIP top up, be it STP. The biggest benefit you get is that at every interval of daily, weekly or monthly, a little bit of your investment or a little bit of your corpus is getting invested in equities. As we know that equities are an asset class which go up, then they come down sharply, then they again go up, then they'll come down, then again go up. So if we have investment in equity markets or in equity funds at the peak of market, if someone invested in January 2008 a lump sum amount, that person would have lost a lot of money when the markets came down. But if that person would have invested, and we've done that calculation actually, if that person would have invested or through a SIP route and systematically invested through 2008, through the fall in 2008, when 2009 the markets rallied, then again there was a flat period 2011, 12, 13. The investor's return experience would have been better instead of putting the lump sum money in 2008. So the biggest benefit you get when you invest systematically is that you get the benefit of rupee cost averaging, invest across market cycles. And the important is when you're starting a SIP, technically it is a 10, 20, 30 year investment which you are making. Don't make a SIP for 3 years, 4 years. It does not help you create long-term wealth creation. The power of compounding will not kick in unless you keep your money for at least 10 years, 15 years in equities. When you want to see real wealth being created, keep your money, invest money systematically and keep it for 10, 15, 20 years. That's the biggest benefit of systematic transfer. Plus the fact that you don't have to worry about having money in your bank account, etc. Else, there may be a chance that money is not there in bank account and that particular installment does not go in terms of the investment. That particular investment is not made at that point of time because of lack of funds. Systematic transfer plan takes that away. You already have money in your fixed income fund, and from the fixed income fund, it keeps getting invested in equities. So these are the two benefits which are very, very significant, and it's also about discipline. So if you want to invest in a more disciplined way, this is the way it will ensure that you are disciplined in your investing. It's very difficult. It's a very easy word that we should be disciplined in investing, but doing it is difficult. And STP, SIP, SIP top up ensure that the discipline is brought into us or is instilled with us without us having to remember it every month. Once you start an SIP, SIP top up or an STP, then it is automatically taken care of for 2, 3, 4 years or 5 years, depending on how much purpose you've invested or what is the tenure that you've chosen. So I think discipline, rupee cost averaging, and the fact that the power of compounding over long periods of time, plus the lack of the risk levels are much lower, because if you're investing lump sum in the peak of market and the markets fall, I think emotionally it can cause a lot of drain, and that is something which has kept 98% of Indians away from equity markets, which is the sad part, because FIs have bought almost 21% of the overall market cap in the last 27 years that they've been allowed to invest, while Indian investors are less than the retail investment. Only 2% of retail investors actually invest in equity markets. So we hope to change that. Things are changing. The SIP book is improving, and it is a very rational and a good way for people who do not understand equity markets to invest and allow their investments to grow. But have a tenure of 5, 10 years. Do not invest in equity markets for 1 year, 2 year, thinking that equity markets give good returns in 1 or 2 years. I'll take that money out. That's not the objective of equity markets. Equity markets over long term, if you keep money, power of compounding will ensure that you have wealth created in equities as well. With that, probably I'll stop, and thank you and happy investing.
ICICI Prudential Mutual Fund. Tarakki Kare. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.